Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, guys. It is the 19th and we've got a pretty crazy market out there. Hold on, I was just wanted to look up here. Is today Thursday? Philly Manufacturing Index and unemployment claims coming up here in a second. Also, don't we have oh, okay, never mind. That's next week. I was thinking about Jackson Hole, but no, it is next week. Okay, hey, we got a market that's just falling apart here, man. So what is going on? Well, yesterday, things were pretty okay, maybe a little bit down, and then the FOMC meeting minutes came out right about there, and the markets ended up not liking that and sold quite significantly. Now, here's the thing. Remember this move right here. Let me get my pen out here so I can highlight it for you. This move right here was a pretty crazy options-driven melt-up, right? Anything below that, those options are underwater. And remember, what they try and do with this strategy is they want the market to close as high as they can so that the next day, they have more margin to buy even more. So if the market closes below that, that means that they have lost a lot of money and that they don't have as much money to continue buying off as options. They're going to have to deleverage. So I believe that a lot of this move is technical forced trading. And will it last? I don't know. This would be a kind of situation where maybe you could have a bounce. But the thing is I don't know how much of that flow is done. Once that flow is done, we could probably see a strong bounce. Now, why do I think that it's just that and not a wider read on the FOMC minutes given the timing of it? Well, because the treasuries moved up. So the FOMC minutes pretty strongly hinted that a taper was coming and that some participants were concerned that the asset purchases were doing more harm than helping at the time. And I think there's some solid logic to that whole argument. So we see the treasuries go up. That must mean that they are going up because of flight to safety. Because if they were trading directly off of the FOMC minutes, I think that their propensity would be to sell and for yields to increase. So that's basically what we got going on there. Now, oil is just terrible. Gold was not that affected by this. Okay, so that's another thing to point out here. If yields are going to increase, then you'd want to sell gold, right? Copper, a third day of just absolute slaughter, and we are at like a 90-day low. So, woo. Okay, and then when we come over into the currencies, okay, now we need to come over to the 60. Dollar strengthening. Okay, so what I see is a risk-off sentiment move, and maybe not necessarily a interest rates are moving up, deleveraging kind of move. Okay. Now we got some numbers coming out here in 2 minutes. Also, Bitcoin down a little bit, but not actually moving all that much. The Bitcoin seems to be unaffected by all this stuff, even though I think there's every reason that it should be. Okay, so How are you guys? Text to speech. Turn that on. It's kind of funny. I use the text to speech to read your messages, but I like for them to show up in the window. But I very rarely actually have them read out your messages anymore. Good morning, Lucas. Oh, what were you saying the other day? You sent me a message, didn't you? Oh, that was 2 days ago. No, oh no, you left me a message on. You left me a comment on one of the videos, didn't you? That's what it was. Forget what it was. You were saying something though. Oh, that video. Yes, I need to watch that. You know, when they put it up, I didn't know who those guys were, and so I didn't watch that webinar live. But if you say that it was interesting, then I'd say it's worth looking. And when I was skimming through it, I looked like they were talking about some more advanced topics. So, you know, it looked like they were kind of maybe more former institutional guys, yeah? So we'll check that out. He talks about market flows. That's good. Lucas says, yeah. See, the thing is like, as much as I might know, I feel like at this point I have a pretty good intermediate grasp on kind of the math behind the order flow and stuff. Okay, so are we moving? Are we moving? Okay. Initial jobless claims 348 versus 362, so lower than expected. Philly Fed 19.4 versus forecast 23.1. So the economic indicators that we continue to get are bad. It has timestamps. Yes, it did. Oh yeah, let's change the screen. I'm glad that the screen was not showing my other screen so that I would have to go back and redo all that. GE Appliances and Google signed deal to build smart home appliances. Oh boy. I don't get, why do I need my refrigerator to be... Oh, actually, I take that back, because if my refrigerator knew all of the items that were in my fridge and then suggested what I should make for dinner based on when items are going to go bad and so on and so forth, and my own dietary requirements, that would be so awesome. This is what I want. I don't want to decide what to eat. I want the robots to tell me what to eat. You know? I want the robots to tell me what would be best for me to eat. And, you know, because honestly, how does that dinner thing always go through? What do you want for dinner? I don't know, food. Come on. So let the robot decide. Let the robot decide. And then we can have a robot make it for us. That'd be even better. Oh man, do you think that when we have, you know, catering robots in our houses, will people still want to go and eat out? I mean, if the robot is good at it. I bet you, though, that you're going to have to pay extra for, like, better recipes or something. Like they're going to find a way to nickel and dime you on, you know what I mean? Microtransactions and stuff. You can have ours, you know, we'll make you chicken Alfredo, but to have our extra tasty chicken Alfredo, it'll be 50 cents every time when we make it or something like that. Okay, well, it looks like at the moment yields are maybe increasing a little bit here, but the market's not moving a ton. I'm having a hard time sorting out in my mind if these flows are going to continue or not. Like, is today a buy the dip day? Like, it would be. Every other time that we've been in this kind of situation has been buy the dip. I would say buying the dip is not necessarily in line with the fundamentals. I think a lot of the economic indicators that we're getting are suggesting that we're going to have a really soft third and fourth quarter, right? 50 cents, yes, after they ditch the dollar and make it. I really don't think that's ever going to happen. Why does everybody... Oh, you know what it is. It's the whole freaking the gold standard. Here's the thing, is that people in America have been really attached to the gold standard for a long time, and there's a lot of people that are still really upset that Richard Nixon basically took us off of the gold standard, but it was inevitable. It was inevitable. I wonder, are there countries today on gold standard? Are any countries still on the gold standard? Well, the gold ATM concept has achieved some level of success in the UAE. One fact remains: the Emirati dirham, the fiat currency of the country, is not backed by any gold itself. In fact, no currency in the world today is on the quote-unquote gold standard. Switzerland banned the practice 2 decades ago. Yeah. I don't know. I don't think it's ever going to happen, Lucas. I mean, yes, it was politicians want to run the currency, but look what happened with the dollar after Nixon did. Well, but it's not. I wouldn't say that fiat gives them, because we have an independent monetary system still, right? Like the Treasury is quite independent from Congress. At least. Well, I guess Congress determines how much spending in all of the dollar amounts. I guess that's true. Mixed belly Fed report, but no promising signs in the employment component, and new orders something of a silver lining to the weak data points in the past week. Not at all from my point of view. Politicians do control the budget, and that in turn, I suppose, controls the money supply to some extent. But the Fed is in charge of that, right? 10-year kind of ticking up, kind of threatening it there, but the yield's not moving. Copper reflation longs carried out on stretchers tweets the market ear. We could use a semiconductor standard instead of the gold standard. No, I really think that you don't want your currency tied to a physical good. Like, so the issue with it being tied to a physical good is that it can be manipulated then at that point, right? You constrain or increase the supply of that good, and then it could positively or negatively affect economies. And that's what kind of one of the big problems with it, right? Whereas in a fiat currency, you're able to adjust it based on the financial conditions. Now, there are still constraints on it, right? Because There are constraints on like how much debt you can take out and inflation problems and that sort of a thing. But that has resulted in far more financial stability than we had when it was gold, frankly. And then the Federal Reserve System has been a very effective system. Like, I don't think we realize how much of American success over the past 100 years or so is due to the Federal Reserve System. What site is that? What are you talking about? Are you talking about just what you see on the screen right now? You know what? I think I want to modify some of this. I'm looking at my workspace. I'm like, I can do that and that. And then this has to be like this, which means that we got to hide the 1. Huh. Not quite enough. There we go. And then I'm going to make this a little wider and this a little wider. I might go back at some point and modify, like here in the E-mini, I really use these alert columns, for instance. That makes it look a little, just a tiny, oh, except for that, then there's my, let's see here, properties of this. Oh. Okay, there was a reason why I had it like that. Because now you kind of got this little sliver here. Okay. Okay. I get you. The thing is that I don't want to come in and have to increase the size of all of these, you know? But I guess what I'm going to have to do is I'm just going to move this one. I'm just going to make that order column a little bit bigger. Okay. That should work for now. Oh, yes, what broker? Okay, so if you want to learn more about the software that I'm using, I have a video on my channel called What is the Best Futures Trading Software Platform. The program that you're looking at mostly here, all of the depth of markets, is called Jigsaw Day Trader. And I am currently with NinjaTrader Brokerage. So I run NinjaTrader and Jigsaw Day Trader alongside each other. Data goes into NinjaTrader and then gets passed on to Day Trader. And that's how that all works. Morning, Keller. Well, there has been a slight increase in yields here. Coronavirus update. Well, did you see that in New Zealand they had like 5 new cases or whatever? Oh my gosh. CNN reporter responds to Biden saying Afghanistan withdrawal was not a failure. A lot of people outside the airport would like to know, if this isn't failure, what does failure look like exactly? Okay. Tell me this. Answer me this. In Afghanistan, before all of this happened, we had about 2,500 soldiers in Afghanistan, according to my understanding. Was that really that big of a burden? Was everything that has happened since pulling out worth getting rid of 2,500 soldiers in Afghanistan? Because I'm starting to think, I was partial to this whole thing that, like, well, we can't stay in there forever. They need to stand on their own at some point. And I'd be okay with that as long as, like, we continue to support them to some extent and prevented the government from falling apart. Because what the Taliban has been doing since Donald Trump left office is really quite startling, right? That they just did that and we just kind of sat there. But now I'm sitting here and I'm like, people say, well, we could be there 100 years or, and I'm like, sure, why not? Like, we still have soldiers in South Korea. Why can't we have soldiers in Afghanistan? Like, that's, I'm kind of coming around to that sort of idea, but it's still very, I haven't necessarily thought it through all the way, How much money were we actually spending in Afghanistan a year? Because it's frustrating to me. We're willing to spend trillions of dollars of the global economy to fight the coronavirus, which, from everything that I understand, mostly kills people over the age of 70. But then the money that we were spending in Afghanistan was too much. So I don't think it was as much. It was a lot over the long haul. But recently we've only had like 2,500 troops in there. Yeah, them treasuries look a little heavy, folks. But the E-mini's not like jumping up. I don't know. What happens if the E-mini opens back up and they sell? Do you think that the treasuries will just rocket back up to highs? The Afghans are now sitting on about $1 trillion worth of minerals. Our supply chain just got more complicated. Yeah, well, and it's all rare earth minerals. So I think that the thing was, I don't know if we were ever going to actually get those minerals, but I think that the concern is that, like, China definitely will. Think about how much you spent already trying to stabilize and train a government that surrendered overnight. Yeah, but they keep saying that the reason they surrendered was because the Biden administration basically undermined them, that they were trained to be dependent upon U.S. infrastructure to function, and they removed that infrastructure. Keller is catching. He's probably like watching it on double speed to catch up to where we are. Your commentary on upcharging maker robots reminds me of a graphic novel series called Transmetropolitan. Okay, I'll have to look that up. Oh, look, they come back up there in the treasury. I don't know. Like, I'm a little concerned. No, should I say concerned? I mean, I would be happy if the treasury sold down, to be honest, even though I don't have a position or anything, but I'm thinking maybe the treasuries want to move down, but right now they look like they're just meandering. Anyways, like really think about if you were in that situation, okay? Your ally that's been propping your government up doesn't want to be there anymore, and the Taliban is taking over. They don't do anything about it. Even if there was, so I'm told that even though Biden keeps saying that there was like a 300,000 strong Afghan army, that it was really actually like half that. But if you were in that situation, would you really be willing to put your life up for it? Oh, I don't think you would, and so I feel that a large part of why the Afghan army just surrendered was because of the way that we did it. Because like nobody actually thought that they would be successful, and they basically like it, it was like a self-fulfilling prophecy. We created a self-fulfilling prophecy where we expected them to fail, and so they failed. Why intervene in the first place? Well, because we were there. Okay, like we intervened in the first place because of 9/11. Okay, well, we needed to do something about that terrorist cell there. Then we're there and we're in the nation building mode. Okay. Now there's kind of this question of like, when should you have pulled out? But I would argue other administrations, they had invested in there. There was the surge thing. There was all that sort of stuff. Okay. And then we get to the end of Donald Trump's presidency. Okay. I say at that point, if we say that everything in history up to that point, we can't change. Okay. And we just get to this one decision, which kind of really started with the Trump administration. Although I would argue the Trump administration would have done things differently than what just transpired. Okay. What do you do at that point? And I'm arguing that I think at that point that 2,500 soldiers is not that big of a sacrifice. Khulud wants to buy it. Well, I guess we should note that we're getting a little bit of steepening again today. I wish that these DOMs down in here reflected better how steep the curve was, But because their spreads are so large, it doesn't really show you that. 2,500 soldiers are not that many when you're trying to hold a city. Yeah, like when you put it in perspective of we only had 2,500 soldiers in Afghanistan for the whole country. Like, come on. And you have like a forward operating base that would be important in the event of like a conflict with Taiwan, or not with Taiwan, but with China over Taiwan or something like that. Now you don't have that, like, because the thing that I'm thinking in my mind is, okay, well, Joe Biden executed this badly, but what does this say for the larger political philosophy of what I'm going to call anti-American imperialism, even though I don't really feel like that what we were doing in Afghanistan was American imperialism. But that's kind of the group of people, is they don't want us to be in those places. They didn't want us to be in Vietnam, and that part of the Democrat Party has just kind of been around for a really long time now. Yeah. Hold on, my Discord here is a little... twisted. Before Vietnam was the Korean conflict, yeah. But so I'm wondering, do we decide that, if we go into a place, if it happens again, that the best thing is to just stay, even if it's staying there for a really, really long time, as long as the amount of resources that you're spending there are relatively minimal? That's kind of the question. And where will the American public come down on that question? The Silk Road and rare earth elements, that's one reason to be there. Well, yeah, I'm a little concerned. It's kind of interesting. You can't really make any reading on how that affects the markets here because miners overall worldwide have been getting creamed lately. If this was a game of Risk, would you keep your armies in Afghanistan? This isn't a game of Risk, though, Win. Welcome back, Horse Mumbler. Well, so the Treasury came back down there. So the thing I'm noticing here, Treasury still appears to be meandering. But when it comes down, it does look incredibly weak. They did not trade a whole lot of contracts to get down there. So I don't feel confident in putting a lot of risk on here for all this. I do kind of feel like if I was on a trade that I would like to be along this somewhere. Maybe somewhere down in here in the 23 and 123.4 basis points. Groups call on Apple to drop plans to scan children's messages. Don't trust that 4K at 14 in ZN. Yeah. It does kind of feel like they're fishing, doesn't it? The thing is that something that I've found interesting lately. This is just kind of like one of those side thoughts that I have in my mind and I don't see anything about it. But I've seen a lot lately in the Treasury. We'll come down below a level and then you'll get a big stack like that. And you think, oh, okay, is this stacking because he wants out and he's trying to create sell volume so that he can exit his positions? But then what seems to happen in those situations is that what happens in the 5-year is really what determines the price anyways. And so what's stacked there in the end is kind of irrelevant. I'm watching the schools in Florida in my 2 home countries, in Tampa Bay and over in Jacksonville, and they're getting slammed with children catching COVID. Do you worry? No. Because children are extremely unlikely to die from COVID. Quite frankly, as long as our hospitals can handle it, I'm okay with whatever number of COVID cases we are. I don't want the death rate to start increasing. If death rate starts increasing, then that says that maybe we've done something wrong. But number of cases overall is not a metric that I'm concerned about. You stick your kids outside in the sun, Gears. Like, especially from the perspective of kids, like, I'm still thinking about this. Like, it appears that the efficacy of the vaccine may wane over time. And there's like the booster shots and things like that. If you are a kid, if you are under the age of 20, I suspect that your chances of catching COVID at some point in your life are something like 80%. So that you catch it now, is that so bad? Did you see the thing from the Biden administration, though? Oh, man. Yeah, I heard the hospitals have no more beds. Not sure if it was Florida or Texas. No, I think it was Alabama that was having the worst problems. But apparently the problem isn't so much that our hospitals do not have the ability to fill the capacity, but rather that nurses are quitting. And so we don't have enough staff to man them, which is kind of interesting. Anyways, no, the Biden administration yesterday, he had a press conference about COVID, and one of the things that they're doing now apparently is there's states where the governors have said you cannot enforce a mandate. So, like, listen, if you want to wear a mask to school, then by all means, but they're saying you can't force a mandate. You have to wear a mask or you can't come to school. And the Biden administration is going to sue them over that now. Can you believe this? When I read that, I'm like, they're insane. Like, I do not think that will hold up in court. Yeah, Biden is trying to overrule DeSantis. That's exactly what it is. You know, interestingly enough, let's see if I come over here. Let's try hot air. No, don't. Oh, here it is. Their headline is, having been humiliated by the Taliban, Biden decides to fight with DeSantis over masks in schools instead. It's written by all up on it. You know, I don't like this guy because he is way too deep in the Twitterverse, and he comes up with all sorts of theories and stuff based off of people's perspective on Twitter that I'm not, isn't always in line with what reality is. So their take is he wants to have this fight so that it distracts people from Afghanistan. Yeah, okay. Percentage of adults supporting mandatory masking in schools, August 13th through 16th. Okay, Republicans 44, but Independents 67. That's a little bit higher than I thought. I thought it would maybe be more like 60%. So sure, you go in and you take a now they support mask mandates for school, but I don't. I really don't think there's any reason for my kids to have to wear a mask, especially when I'm not even convinced that it actually does anything. Well, okay. So that's something that we should keep in mind about it, though, is that it does appear that they're on the right side of the public, at least with that fight. The thing, though, is you're going to fight governors over it. I think that's a bad idea. Do these people not get the hypocrisy of wanting government mandates for vaccines, but then don't want to let the same governments then not require masks when they said we wouldn't need masks after the vaccine? Yeah, okay. I'm never sure how the whole states' rights thing is supposed to work. Yeah, it is. Because, well, so here in Utah, I think it's an even bigger. So in Utah, it wasn't just like the governor said, No, in Utah, they made it a law. The schools cannot shut things down. The county can. The county can say that there's an emergency, and the state Congress or state legislature can overrule them. So, like, there's this whole state system set up to determine when you can or cannot enforce a mask mandate, right? And the Biden administration thinks that they can just come in and overrule all of that, huh? I'm not sure they would win that one in court. Well, but here's the thing is what I find interesting is that they're using like civil rights laws to sue them. They're saying it's like a violation of students' civil rights that they have the right to be protected or something, or that it's like particularly disadvantageous towards minorities. It's like, okay. LDS leaders are embracing that wearing. Yes. Well, not. I don't think that it was reluctantly. So the church has been from the very beginning. You got to understand that way back in the LDS church's history, it was basically like the government was going to come in and will wipe everybody in Utah out if they didn't stop practicing polygamy. Like that's like literally what it was turning into. And so the church in modern times is almost overly sensitive towards what the government wants people to do. And so they always teach that you should follow the guidance of local government leaders and things like that. So when the government says you should get vaccinated, you should wear a mask, etc., etc., the church 100% says that you should go along with those things. But what is interesting about this more recent thing is that we started to open things back up, at least here in Utah. Like, I was going to church and nobody was wearing masks at church. And then they came back out and they said, you should get vaccinated and you should wear masks. And so it's all getting rolled back. It's going to be interesting to see how that affects activity levels, because I know that for me personally, when they say you have to wear a mask, I'm not going to go to church meetings. They stream it on Facebook. I'm just going to watch it on stream on Facebook. There's no way that I'm going to go and sit, especially I'm going to be sitting there with a toddler. Like, can you imagine this? I'm sitting there in church with a toddler with my mask on. Toddler doesn't have the mask. He's still too young, okay? And he's trying to rip our masks off the whole time. Like, it wouldn't work, okay? Not doing it. I'm not doing it. We're talking about Mormons, AO. Yeah. We're not supposed to say LDS anymore. We're supposed to just say the full name of the church. Or I don't know. So what the preferred terminology is always changing. I forget where it is now, where they're at now, but I think that that's going to be the case for a lot of people, that a lot of people are just going to say, okay, fine, I'm going to stay home. And then, like, activity level in the church declines. And then, like, I'm concerned that when you open things back out in where I live, it seems like everybody came back and it was just like normal those few weeks I was going. But I'm concerned that, like, activity levels overall will drop and that kind of be a bad thing overall. Some spreading going on? Yeah. Well, I don't know, Lucas, because it looks like what happened was there was quite a bit of steepening and it has flattened back out. So the 5 year has moved quite a bit compared to the 10 year. Do you see how the 30, it's actually really, maybe we can draw it here, right? So there tends to be some convexity around the 10 year here, right? So you can kind of see it. This one probably should still be over here, but you can see it there between the 5 and the 10. The 5, the yields rose a lot more. I thought that the term Mormon was still, yeah, I don't think that that's what they're supposed to. Mormons claim that they're Christian, but Christians claim that Mormons are not Christian, because Christians do not believe in the Nicene Creed, which is that God, Jesus, and the Holy Ghost are the same entity. Mormons don't believe that. But they do believe that Christ was a God and died for our sins. So there's controversy over that one. So why Mormons tend not to interact with the larger Christian communities. They hate them. They hate the Mormons, that is. Okay, so the 10-year definitely moved there. Who would be offering up 7 right there? Yeah, well, what is and isn't a God in Mormon theology is a whole different subject for a different stream, a different type of stream. I don't think that we should get into that. And the LDS Church doesn't like to talk about it as much anymore because the actual doctrine on that is not really very, how to say it, like mature, standardized, whatever. They don't understand. There's lots of questions they don't understand about that. Ace says, what the crap down? Oh, I don't know. I think, I'm looking at this and I'm still thinking the normal call here would be on the open buy S&P 500. Yields are increasing, which kind of supports that. I don't know. I think that buy is the right call, but buy the yield. This guy is trying to squeeze them. Do you see that? I didn't get it. There, you got it. We're waiting for the buck to break. Oh man, the dollar has been trading in a really tight range, hasn't it? Okay, so there's a 10-year trying to break into 11.5, but there was a decent amount of volume there and buyers pushed back. And the yields come back as well. Well, of course the yields come back, but it seems to me there's not a linear relationship between these two things. USD JPY trades above and below its 100-bar moving averages, huh? Move overnight in the 6J is definitely pretty crazy. What do we got at the top here? I guess MES is at the top of the list in terms of activity. So yeah, all retail's buying it. Bitcoin is doing something. I guess we're getting a relatively high amount of activity in the 10-year right now as well. Do we have? Oh, we have. Oh no, that was yesterday. No, that's next week. Today. CB leaning index and mortgage delinquencies at the top of the hour. Oh, that's interesting. Financial Juice is doing some of their alternative streams on their Discord. On the live Squawk voice channel on the UA. What is the UA Discord? Of course, they give me an invalid invite. What structural issue do you think will show up in the treasuries if the reverse repo hits $2 trillion by quarter end? Well, I think part of the reason why the FOMC seems to be very supportive of reducing asset purchases and saying that, hey, maybe the asset purchases are harming more than helping is because the reverse repo facility is so high. So I think that the thing we should be concerned about, though, is that the interest rates are going to rise too quickly. Like, just the way that this has been happening, the way that, interest rates declined overnight, and we're relatively high. I mean, we're not as high as we were at the beginning of the month, but we're relatively high. And when you think about the beginning of the month when we dropped, and you look at how far we can go, like we have a full 3 points here in ZN that we could go, and imagine that we go to that almost within a week. Like there could be a very, very dramatic rise in interest rates when they taper. So all of that money comes out of the reverse repos, right? And yeah, it could get ugly. So maybe this will introduce a shakeout in the market that has been needing across this major cycle. Well, yeah, it could, but it would also be it could also be problematic in that it could reveal other structural issues, right? Like if we come out and we have a 10% haircut in the equities, then that would be great, right? Like a 20% haircut in equity markets, I think would probably be healthy, but not if it happens all at once and the interest rates rise at the same time, and like this all happens within like 3 days. And that's kind of what I'm concerned about. Because then what's going to happen is you're going to have all of these guys that were like over leveraged in a certain direction, and they're going to get blown to bits. So I still see a little bit of pushback here in the treasury, but the selling is definitely stronger. At these levels, 10% seems like everything would still be overvalued. Yeah, I mean, and the part of the problem here is that something that I'm noticing is that the market doesn't seem to factor in future changes in interest rates. You get what I mean? Like they come in and they say this is the valuation of the S&P 500 based on the current interest rate, and they don't come in and say, well, yes, but when interest rates rise 50 basis points or whatever, then it's going to be worth this. They don't. I don't think that the robots think that way, and that certainly is not what the prices are reflecting right now. And so the question is, when interest rates normalize, what do the prices actually come back to? Do they stay where they are, or do they come back considerably? And that's where I'm saying that's what I'm concerned about, is that they come back so hard. I see that in options, no one, even now with interest rate changes on the table, talk about row risk. Yeah. And the options, I think, is a key thing here too, is that I see markets moving off of order flows created by options, and not based on what's actually going on. Like this move that this decline that we had yesterday, I don't think that was because of, well, I mean, it was kind of triggered, of course, by the FOMC minutes, but the FOMC minutes were actually dovish, and I think still suggest that asset purchases are going to taper. So you should see the S&P 500 maybe decline, but you should see interest rates rise, and that's not what happened. So that's where, again, I say, like I said it when I was reviewing the charts at the beginning of the session, this move appears to me to be almost completely options driven, that people like way over leveraged themselves at the beginning of the week trying to push the gamma, and had to deleverage essentially. This is where I think Jamie Apes are right about privileges with regards to option creation are the systemic risks in this current area. I don't understand what you're saying there either, Ader, because the ones that are creating the problem in the options are all of these retards buying far out of the money calls to try and push the price, and then using their mark-to-market rules to leverage themselves even more the next day. Market makers need to be restricted to only create derivatives. Well, that may be, but I don't think that that's what's causing the specific problem that we're talking about. The gamma melt up kind of move like we had on Monday. That's not what's causing that. What needs to happen to fix that is that mark-to-market rules need to factor in the impact of selling. They need to say, if you sold, how much would that impact the price, and bring it down. And that's what your margin then becomes, so that you can't just leverage yourself with more and more margin by pushing the price. Apes cannot buy options unless the counterparty writes them. Yes, but the counterparty just puts it out at what the current price is, right? Like, you realize these guys don't really know anything. They're just putting orders out there and maybe adding or removing them based off of a correlated instrument. And a lot of what determines how successful that system is how many orders do they pull when they're getting adverse excursion, you know? He didn't say retards buying Doge. Well, I'm not convinced that many people are buying Doge right now, to be honest. Be surprised if the market falls 50%. I don't know. We would have to be wrong about a great many things for that to happen, but it's entirely possible. Because he says, yay, my yields are you long in the yields? Oh, Uzi says I just bought them up. But they're working. I gotcha. We are preventing any form of violent verbal clash at the airport among Afghans, foreigners, and Taliban members, says a Taliban official. Yeah, okay. There are guys every year who say the market will drop 50% for sure. Well, there was certainly people that thought that it would happen this year, wasn't there? Can't keep the DOMs up. There's like nothing to really. I mean, the 10-year is starting to get interesting. I think in this case that it is. I think that we're learning some things from watching this thing progress. You know? So we'll look at the rates right now. Okay. So there's these market makers. Let's just say all of these like hundreds don't matter. Okay. But maybe if there's like twos or threes, then that might tell you something. So what are the retail traders doing right now? They all want to be long. They kind of have some orders down in here just in case it falls back on them, for them, rather. Rates are, so we are still seeing the rates be really sensitive to what the S&P 500 is doing. Numbers are pointing to next month. I think that when you factor in seasonality and the current fundamentals, that September, October are likely to be difficult months, yes. A lot of that depends on what happens next week with Jackson Hole. Dollar will become, I'll see now you're starting to make crazy predictions. This is the one that I always think is funny. If I was a foreign government, I would not take dollars. Well, okay. We can both become foreign governments. You cannot take dollars. I'll take dollars. We'll see which government does better over 10 years. Let's look at the last 10 years. The governments that took dollars, doing pretty nice. Ones that didn't, those are like, all of the countries that are like the biggest slums in the world. Does he sound crazy with the Palantir news around gold? You know what? Yeah, I'm gonna say it. I don't trust Palantir on what they're gonna say for an investment decisions in the least bit. I think that the stock is overhyped. There's not actually like a really clear like what they're actually providing for people. The only reason that it's doing well is because of the names that are involved and not because of what they've done. And they have shown no efficacy in predicting future market action or anything of that sort. And so for them to come in and say we're hedging against a black swan event, which is kind of like an oxymoron because you can't predict a black swan event, right? So I think that coming in and buying gold because Palantir owns gold is makes zero sense. I would say it is counter to the investing principles that I have come to based off of empirical evidence. One of which is that you don't just want to follow other people. Key takeaway I took from that news is they bought physical, not paper. Paper if leverage against physical, so they will get to write contracts against their physical holdings. It could be. USD is weak, but what alternative is there? I mean, and that's the other funny thing is that the dollar is historically pretty high right now. Just remember that you're talking to a person that remembers when the dollar index was like 50 and now it's at 90, 100, and it's like, what the fuck? I don't know. So here's the thing is when I get on Reddit, for instance, or just on the internet in general, you tend to see a lot of people bad talking the dollar. And you tend to see a lot of people concerned that the dollar is going to lose its supremacy and that it's going to be really, really bad for the United States. Okay. I think there's a lot of political reasons why people would say that. Okay. A lot of it is because there's a really large contingent of people in the United States that are concerned about the national debt. There's a contingent of people that are worried about competition from China. Tends to be more conservative people, but there's people on the left side of the aisle that think, imperialist America, it's going to fall, and all of these sorts of things. Eventually, other countries are going to get tired of the United States crap, and they're going to move over to a different currency. Okay? That's what I see over there. So I'm like, okay, that's why they believe that sort of stuff. But then I come over here and I look at how do markets behave? Okay, well, when markets are scared, when we're having a risk-off move, if there is one thing that is reliable, because, usually treasury yields move down and they buy treasuries, but as of late, the treasuries are already so high, and so that's kind of been a little bit of a questionable thing. But if there's one constant, it's that when there's a risk-off move, the dollar moves up. Every time. Almost every time. Right? So from the perspective of like traders, why would traders say that? Because their political leanings outweigh what they see happen in the markets. But I just don't think the idea that the dollar is going to lose its supremacy really makes a whole lot of sense given the current economic landscape. Where are you going to go? You're not going to put it in the Chinese yuan. Okay? You're going to go and put it in the yen? I mean, the Japanese yen? Well, I mean, the yen does kind of come to be a flight to safety sort of issue. But if you are, for instance, concerned about, debts, for instance, then the yen is like the worst place to be, So it just doesn't make much sense to me that the dollar would be collapsing anytime soon. Because why? The people use the dollar for a reason. It's the most stable country in the world. It has the strongest military. It has the strongest financial system, and it has the largest consumer purchasing base. And all of the competitors all have big problems that prevent them from overtaking the dollar in those respects. And the dollar will continue to be the dominant currency in the world until it is no longer the best at those things. And it's not going to be China, because who would trust to put their money in China? Like, seriously. Get rid of the dollar but replace it with another fiat. I'm not sure why you'd go that route. Well, to that point, I think that it would be very, very difficult to replace fiat currencies. Okay, so the E-mini is definitely buying the dip, and pretty hard, I might add. Well, I've just kind of sat here and been like, I want to buy it, and never did anything. RJ says I agree with you for once. You want to go and replace the dollar with tethers? Okay. This is a pretty strong buy the dip move that we've had here in the equities. They are running into a bit of a roadblock here at 78. As long as you accept technical indicators show as T chart strength, like show. I'm only saying my only claim is that technical analysis is ineffective trading in short term. I'm saying that if you put up a 1 minute chart and you trade off of technical analysis over 5 years, that you are unlikely to be very successful. Well, there's the mistakes of 1 minute, even if you did a 5 minute chart or a 30-minute chart. If you were doing it on like daily charts, then there's maybe a different sort of a thing. But it's a completely different game. You're comparing apples and oranges then at that point. But I'm saying you take any kind of intraday chart and you try and trade it with technical analysis on a risk-adjusted basis, you're not going to do very well. What if you add in statistical ranges to that TA? No, I don't think it would matter now. That 10-year moved a lot more than the 2-year. Okay, so the E-mini got past that first little hitch, and at least for now they're trying to push higher. There is a possibility that they just kind of get stuck though still. The treasuries kind of seem to be backing off a little bit here. And where do we get to? Well, so in the 90s, once you get into the 90s, you're running into like gap fill. Like if this is a gap fill move, then the target is 43.90. So even though that was a really strong move up, they're still kind of vulnerable. Like, well, that actually is a pretty strong down move. You know, like where was the open at? Oh, how come okay. 43.65.75? Yeah, that's right. Well, that's a long ways away, but we can just kind of keep an eye on that. Or another way I could put it, what I'm saying about technical analysis is that if you take a technical analysis signal and you have an equal risk reward of about 16 to 24 ticks, that you're probably not going to find a signal using purely price technical analysis that's over 55. That would be a more quantitative way of putting it. The technical analysis strategies that seem to have some efficacy don't make enough beyond their trading costs to be worth trading. In order to like get something that's worth putting the effort into, you have to start taking excessive risks, essentially. Okay, so the yields are coming back here really hard. Didn't realize the VIX spiked. I wish I could see the VIX right now. Public Health England say the COVID-19 vaccine rollout is estimated to have directly averted between 91,000 and 98,000 deaths in the country. Cool. Well, of course, you can't make a specific range of ticks if the volatility at the time frame doesn't support it. Well, like, okay, pick your range of ticks. Let's go about it this way. Okay, so if you come in and you say, I want to take one contract and have equal risk reward, right? Now, generally, you would base your equal risk reward off of some multiple of the average range, okay? But even if it was less than the average range, let's say that you were just trying to get 4 to 8 ticks, okay? Equal risk reward, you're not going to make enough money to cover your transaction costs, okay? So how do people deal with that? Well, the most common way that I see people deal with that is that they just have a stop that's twice as large as their target. Okay. So now maybe you're making money, but how are you making that money? You're making that money from taking on excess risk. So you have a poor risk adjusted return, right? So what's the next way that people tend to do it? They swing trade. So now they're taking on excess risk. Well, not excess risk, but they're taking on risk in the form of time risk, right? Well, the only thing that is truly proven to be correlated with future returns is the amount of time in the trade, right? So swing trading it helps, but here again, on a risk adjusted return, it's not very good, because when you compare what you're making to what you would have made if you had just bought and hold, you're probably going to find that it would have been better to just buy and hold, right? You understand? Like, if I'm going to be in the market for several days, why not just be in the market all the time? Right? So there's still the issue there. And more to the point, does that prove that your technical signal worked or whatever? No, because the reason you made money was because of how long you were in it, and not because of anything about that was predictive about that particular thing that you found, right? So I'm saying I see all of traders. So then you come back to this other way, which is, okay, take very, very small time and price risk, but only for a very, very short amount of time, and build up some profit, and then use that profit to allow it to run. I think that makes a lot of sense. Okay, and you can make money doing that. But here again, does that prove that your signal that was or derived from technical analysis is effective? It doesn't, because the profit is coming from the risk management side of the equation and not some sort of predictive signal. So if we're going to prove that you have some sort of profitable predictive signal, which is what I think we're really after when I'm talking about, like, does technical analysis work? I have yet to see any data that supports that any kind of analysis on a single price time series is effective at doing that. And everything that I understand about markets and all of the empirical evidence and studies that we've done about this sort of a thing over the past 100 years says that it's kind of impossible for you to derive that kind of an edge simply from price. Because price is just a derivative of the orders, and it's a noisy derivative of the orders. They don't even care what I'm saying. Did not anticipate that steep move lower in ZB discount is real. Yeah, you were kind of thinking along, weren't you? Well, I was thinking long yields, but I was also kind of saying it's meandering. Well, look, it came lower. It's back to where it was. I wonder if they shove back the other way. Are they going to come back to the 13-14 area? It's curious that the treasuries are bouncing so hard when it's only just kind of a mild pullback in the S&P 500, and it's still just kind of being sucked into that liquidity trap at 43.78, which doesn't really tell us anything about if we're going to continue to move up day. It just means that it's going to take quite a bit more buying volume to get yourself out of that hole first. Okay, if somebody figured out a way to be profitable with TA, would they share it? You say both that sharing your ideas is counterproductive to your P&L. Very good. True. So what we're saying in that case is that popular TA is not going to work, right? So like one of the ones that really drives me crazy is like when people say, it's just support and resistance, price action. No, doesn't work. GEHKO asks, so if price action doesn't matter, then why are you streaming? Okay, so your comment is interesting to me because I get that kind of sentiment a lot from people that are kind of more technical analysis people. And I got that comment multiple times last week when I was making my TikToks about technical analysis. And it's as though there's a pretty big group of traders that can't imagine any other way of trading, right? But when you look at how I trade, you notice that I put a lot of emphasis on knowing as much as you can about the markets. I try to have discussions about ongoings in the world. I try to have discussions about what decisions are the Federal Reserve going to make, what decisions are Congress going to make, what do the most recent economic indicators tell us about where the direction of the economy is going, and what are flows that might be created from those decisions that we can anticipate. Right? Should you get out when flow is with you or when flow is against you? Well, I think that you should get out when the flow is done. You have to know when the flow is done. That can be hard. Okay, so the E-mini is doing some wild stuff. Like, there was some really, really aggressive action there. Pushed it down really hard and then back up. And there was so much trading when that happened. And the yields were fluctuating quite a bit too. The 10-year came all the way back to that 11.5, but they've fallen back to 10.5 very easily on only a few hundred contracts. That's all short-term noise. I wouldn't say that it is at all. That's what moves the market. I'm curious your philosophy of a long-term fundamental view versus watching order flow. Well, but I'm not trying to say that you should trade on long-term fundamentals, right? So let me back up. It sure is a strong... Okay, so they're coming up into that 90 now. We'll see what they do. Was it 90? Yeah, 43.90. So they've filled the gap. So it's curious to see what they do from here. Okay. The technical analysis view of markets is there is fundamental information and there is technical information. And I think that the general idea behind technical analysis is that we as retail traders don't have enough information and aren't sophisticated enough to figure things out from fundamentals. And so we watch at technical data, which is all of this information generated by the market, in order to determine what's going. And we look at the chart and we try and use price movements to determine what the larger players believe is happening, and then try and follow the larger players, right? That is the technical analysis view of the world. And what I'm suggesting is that there is so much more. There is so much more than that. Okay? The market responds to changing views about the future and changing views about what future order flows are going to be. The market moves according to liquidity needs, like if an insurance company comes out and sells stocks because there was a hurricane, that's going to move the market. They move based off of forced technical selling because they're a fund and their strategy requires them to take a trade in a certain way, or because they have options and the options gamma is forcing them to hedge. And these are all flows. These are all flows that can be created for various reasons. And flows can be predicted. You can create models and look at how they behave, and in some instances predict how those flows are going to behave. And then I can come over here on a short-term basis and I can watch the order flow and I can see those flows coming in and verify that they are behaving the way that I would expect based on why I think a flow is about to come in. Right? And then at that point, I'm looking at inefficiencies in the market itself, like this thing that happened at 78. Like, I mean, you saw me call it, right? I knew in that instant, because of what happened, that the market was going to have a little bit of trouble around that 78-80 area. And they did. In fact, they had quite a bit of a pullback before pushing through it finally. Okay. Because I can't predict what they're going to do after it. I just can predict that there's going to be a little bit of a liquidity vacuum there and they're going to have some trouble. Right? So that's what I'm saying. The idea that it's all technical versus fundamental, it's not like that. And I want to try and change your whole view of markets. Your whole view of markets should be this: orders move price. Can I predict when new orders are going to come in? How do new orders tend to behave? One thing I'll tell you about how new orders tend to behave: they cluster. For some reason, markets volatility clusters. That's probably something created by humans themselves. They see something and they all submit their orders at the same time. You can take advantage of that, right? So how was Roaring Kitty able to make so much money on GameStop? Well, one, he was really lucky, but two, he was using fundamental analysis. So, and he was trading on very high time horizons. Seth, you trade on technicals based on theoreticals? I think that the concept of what is technical and what is not doesn't really actually matter. Like I've talked a lot about what is technical data versus what is not. And that can be useful, especially when you're talking about like programming something, to determine where am I getting my data from and what kind of data sources are more or less likely to actually give me some edge, or how can I combine different pieces of data to potentially gain an edge. And if you start thinking about it in that way, you can find it's a little bit easier to find some things in programming. Okay. But in terms of like being able to predict where the market is going to go in the future, like what is a technical information and what is not technical information, it's irrelevant. right? What is relevant is orders. If I can predict orders coming in, then I can predict what the future price is, right? But I'm also saying that technical analysis, as retail traders practice it, is largely looking at price and making decisions based on what price just did. And I'm saying that that's useless because of the way that the market works. The market is moved by orders, and orders can be completely random. They might not be telling you anything about what the market thinks about the future of that asset. It could just be flows based off of a rule that a fund has, right? And that noise, the market responds so strongly to those orders that the noise overwhelms any kind of signal that you would actually be picking up. So you can't really do what this idea of trying to get an idea of what the market or the large players think based on price is based on what we understand about how markets work is silly, essentially. You're following a derivative that is extremely noisy. And so almost everything that you're going to pull out of that data series, regardless of how sophisticated your analysis is probably going to be random. So does that make sense, Gecko? Do you think that a market maker can watch order flow with a statistical edge then? Well, yes. So this is a difficult game for retail traders to play, but if you're watching the order flow, you can find statistical abnormalities in them that you can take advantage of. And if you develop models based on anticipated future flows, for instance, a model, I think the most easy example that will make sense to most retail traders is making a model that will anticipate what kind of forced technical selling will happen based on changing gamma in the options, right? That would be a really great example. And that's another way that you can find an edge. And another way that you can find an edge is, and what I do primarily, is I listen to the news and I anticipate how the market is going to react to the news. The market does not know if the future becomes self-fulfilling because of the aggregate order impact of the present. That could be, you could think of it that way, yeah. Caleb says, look at how few orders can sometimes be during a move. Well, yeah, because market makers pull their orders. The whole thing is that in order for markets to be efficient, okay, like if every market had 10,000 contracts at every price level, then maybe markets might be more efficient. Even then, there would be some things that they couldn't get away from. But do you see, like, there's not enough liquidity for markets to really behave the way that technical analysis people want it to. Some orders move price clearly. Huge orders sometimes do move. Well, because there could be big orders on the other side of it, right? The way that orders combine to make moves is really interesting, right? But that is what we do in the study of in the study of order flow, is we're trying to understand how the dynamics of how those orders are placed into the order book affect how it moves. Are you saying I should get out as flow slows down? Probably yes. So remember, if you're getting the advice that I would give there on that one is, remember that the first trade is usually the best trade, right? So if we were trading the S&P 500, and I'll come over to a chart here as an example so that it can walk you through what you're going to do here. Okay. If you got in at 43.62, this is an easy trade, right? This is an easy trade because you can get in. It almost never comes back against you, yada, 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 yada. Okay, now this was kind of before the open. If you got in at the open, this is kind of an easy trade because you caught the beginning of the move. Because remember, the way that it's going to work, if this is here, the number of contracts, and this is time, given a risk-adverse strategy, generally, how many orders you will execute based on time if you're executing a large meta order is going to be something like this. You're going to execute half of it at the beginning and then a quarter of it and then an eighth and so on and so forth. Okay, which means that the market is going to move much more aggressively at the beginning of your meta order. And that's what you are likely to see here in the E-mini as we go along. Assuming there's not some sort of a reversal, I don't know what it's going to do. But if we're just assuming that we have one meta order, then we should get, I don't think that this is because it was before the market, but you're going to get because it's something like this, right? So probably there could be a little bit more, but then eventually, yes, it will flatten out. And as that happens, you're going to see less activity. So when you get a good run, and the big thing that I would be looking for also is like you're seeing the activity, but it just starts going like this. You might see a lot of volume coming through, but like it doesn't seem to move price. They seem to keep getting stuck into the same place. And when you come back to that place, nobody wants to put any liquidity up because nobody actually wants to trade that place. I see now you're using Fourier analysis. Well, the issue is there's a difference between saying this is a meta order and this is how the order is going to behave over time versus I saw this move like this, it must mean that there's a meta order and I should trade it this way. Those are two very different things, right? This is trying to go backwards. This is saying, I know the orders are going to come. Once I know what the orders are going to come, how is the market going to behave? And you can't turn around and say, this is how the market behaved, so this is where the orders came from. You can't do that until well after the fact, at least. So it doesn't really help you trade. Yeah. You talk the talk, but can you walk the walk? Well, I didn't take any trades today. There's a lot of articles about the lag one impact. Well, so yeah. Well, there's this whole thing that meta orders seem to have long-term consequences to markets, right? So you get a big meta order buy in there. There's like a 0.5% chance that the next day or higher chance that the market is going to be continuing to move in the same direction. So because that happens, the market tends to keep moving, right? But that can, again, all be explained by the impact that orders have on the order book and the inelasticity of prices. And essentially, yeah, it means that you have a large meta order, it can continue to affect markets, even if there was no informational content in that meta order. That's kind of where it matters. Is like, if I come in and I say, here is something that matters, okay? The Federal Reserve tapering asset purchases matters, okay? So if I see a piece of news come out about that and I see orders come in at the same time, I can correlate the two together and I can say this move had informational content in it. But if I'm just sitting there and the market moves and I don't see any news and I have no clue why it happened, then for all I know, it was just random. And that happens a lot, doesn't it? Why is it that price moves fast at the beginning of the meta order? Because you'll have more orders at the beginning of the meta order, generally speaking. Unless that trader is really ramping up the amount of risk that they want to take on the trade. So you're using Fourier analysis. I've done nothing about. Oh well, I do have on there an oscillation indicator on there. Yes, that's been on there for a long time. So you want to go and look at that again? I haven't looked at that in a while. Where is it? I will say the one technical indicator that I have found to be useful, but it's not really technical analysis as retail traders understand it. But no, I didn't say that, but I might not have understood what you were saying, Caleb. But R squared is a really useful calculation because it can give you an idea of how much informational content might one series have on another series. That seems to be really useful. So with the R squared that I have on that chart, it's using the R squared on self correlation, on autocorrelation. So what it's saying is when the R squared is really high, there's a high degree of autocorrelation in the market. And so this identifies when this situation that retail traders are looking for, where strong trend leads to more continued strong trending, is actually happening. And so from that perspective, it's useful, but I haven't found a trade where that R squared like alone works, but I made a video about the R squared one, right? Okay, so Fourier series analysis. This is one that we did a little bit of testing on. That's interesting. Oh, did I put it over here? Yeah, this is Joseph. So here was the and from the beginning of the year, use instrument and then include commissions. I don't think you need tick replay. I'm going to turn off the sound so that it doesn't it's not so loud, because this will happen very quickly. Oh, and we need to select the instrument. Yes. And stop 16 tick stop. Okay. Not quite. So Kola says, because market order signs are strongly autocorrelated. So first of all, strongly autocorrelated, I have a little bit of an issue with, okay? The number is 0.5%. So is that really strongly autocorrelated? It's statistically significant, apparently, but it's not like what retail traders think. Retail traders think, and especially not on short time frames. Okay, and that's another problem, is that when we say that they're autocorrelated, that there's like that point, that's over like a really long time period. If trades impacted prices linearly, number 2, trades do not impact prices linearly. There is a square root law to impact, and the larger that your meta order is, that impact starts to wane, and so there's a certain point at which your meta order can get bigger and bigger and bigger, and it doesn't have more impact. Okay, then prices would be strongly predictable. Well, no, because there's so many orders, right? Is, however, observed empirically. Therefore, impact of trades must be history dependent. For example, a buy trade followed by a buy trade impacts the price. I wouldn't put it that way. So if we're trying to prove this empirically, the way that we proved this empirically is they came in and they said, I'm going to buy 1,000 contracts of this stock, and then they would see how much it moved the price. And they worked with large institutions, and they measured that impact, and they were able to find that they were able to make pretty accurate estimates of how much their meta order was going to move the price of the asset. Of course, there's a lot of noise, so you have to perform a lot of tests to see that, but they're able to make pretty good estimates of this stuff. Okay, so I ran that strategy. So this was one of the strategies that we had started to use at the beginning of the year. And it appeared to work really, really well at the beginning. But now when you look at it in the end, is there really an edge to it? I don't know. It seems to me that the Fourier series analysis seems to get you in at a good spot. So I'm not just using the Fourier series. I'm also using a different signal. So what I'm doing is I'm saying you get signal A, then wait for the next Fourier series entry. And that seems to reduce your adverse excursion. But it doesn't seem to work if signal A is not actually a really good signal. What I would like to maybe do is combine it with one of my order flow signals, like one of the J signals that I've been using for an entry that does seem to have some efficacy in, it has a good win rate at least on an equal risk reward. Then we'd see it comes back and you get into it and if that helps or not. But I haven't done that, taken it that far. But so does the Fourier series matter? I don't know. Over the past year, I stopped trading that robot because it wasn't working very well. He was taking pretty long trades, so he had the reward factor of 5, right? I could come back and change the reward factor to 1. And then you can see that the win rate is random. So whatever efficacy he was picking up was largely from the fact that it only went long and it was holding them for a long time, right? So here again, it kind of the way when you start testing it and you change the parameters and stuff, you basically get to the noise of the market matters more than whatever kind of signal I think I'm getting. Yeah, you should feel the indicator, the volume delta. Yeah. Although I'm also finding that cumulative delta. So like here's another thing that I think is really funny. It's certainly the case in the S&P 500, and it's to some extent the case in other instruments that are more of a primary market, but cumulative delta and price are not well correlated at all. They're not well correlated at all. Yeah, well, again, Kulud, you said market order signs are strongly autocorrelated. So, first of all, I don't think that the studies that you are talking about use the term strongly autocorrelated. Because when you say strongly autocorrelated, I'm thinking, okay, the R squared of this thing is like 80%, and it's not. What I'm saying is that the R squared of that is like 0.51. I would be subtracting the oscillation frequency from the volume delta. Oh, now that would be weird. I don't know what that would do. I would have to like really sort out some weird math to get that to filter in. Oscillation is the noise, maybe. But I think that the bigger issue here is like the oscillation of the market, if we call it. It does seem like there's always an oscillation, right? but the periodicity and the frequency and amplitude of that oscillation is constantly changing, and so it becomes useless to make an actual prediction. You know? Why would he want to have more orders at the beginning of the meta order? Any reason for that? Yeah, because there's more liquidity available at that point, right? You trade that meta order, the beginning, the order book is a certain way. Half of your orders come through, that has an impact on the markets. So now the market maker is like pulling liquidity and doing things because of what you just did. So the order book isn't going to be as cooperative for you. So you have to reduce the amount that you trade it, right? But again, if you want to take a lot of risk on, you can do it differently. And you can potentially make more money, but you can also potentially lose more money on that. So most funds use the risk adverse way of doing it. I must have missed what a meta order means. A meta order means an order that is not executed all at the same time. Right? So like if I am a market, or if I am a large institution, some sort of a mutual fund or something like that, and I want to come in and hedge myself against interest rate risks, and I'm going to come in and buy 100,000 contracts of 10-year treasuries or something like that. I can't execute it all at the same time. I'm going to split it up. So the total size of my order is 100,000, but I bought it in small little lots of 100 or something like that, right? And so what they will do is they will say, how much time do I have to execute this? I have to execute it all today, which I think is a lot of the situation that we're looking at. Then what they do is they split today into equal time periods. And then they say at some point randomly during this time period, I'm going to buy X number of contracts. And the beginning of it tends to be 50% of the order. Right? So the first trade is usually the best trade, because you want to catch that first initial drive that will have the greatest impact on price. And then you can let it run and there's more to it. But the majority of your gains are going to come from that first move. And if you missed that first move, it's a lot more questionable to get in because it's going to be choppy and it might just stop you out. So it's always better. It's always less risk and better, more profit on your trade if you get the first trade you get in before the meta order hits. By first move, do you mean the open? I just mean the first wave of orders related to that meta order. So like it could be the open though, right? In this particular instance today, if we know that there's going to be a large meta order of buying based on buy the dip kinds of behaviors, which I think is a reasonable reason to expect order flow in this particular market, right? Then, yeah, I would want to be in before the market opens. But it could also be when the news hits the market. NinjaTrader doesn't support Forex anymore. Well, I mean, I think that the software supports it per se, but there's just like not an actual broker to work with, so you can't use it. Yeah. Meta equals after? I think that meta means like I thought that meta was like of a creative work referring to itself or the conventions of its genre or being self-referential. I think that that's where the origin of it comes from. Oh, I see the treasuries moved back up. I should have taken it. When they came back to 110, I thought, well, maybe you could do it. But oh, look, there's the E-mini. He's going to take another run here. Well, if it takes off from here, I'm going to say that it's probably another set of stuff. There was a pretty good wave of buying that came in there. Biden says dropping initial unemployment claims shows progress, but I'm not seeing anything else coming out through here. Has it gone positive? Is it positive from yesterday at least? Yeah. From yesterday's close. There you go. Meta means an abstraction away from. That's I think the correct usage of the term. Still stormy outside, apparently. The buy the dip in the E-mini was certainly crazy. So the thing is that I've been watching this over here. I mean, I did want to be long, and it did give me opportunities, but I just wasn't enthused enough by them. So I'd have to say that I was just too cautious. If I wasn't trading these, maybe I would have tried going long in the E-mini. They've always bought the dip on options expiration over the past months. Yeah. Although I would say still that if we drop below 43.90, you still have this risk of deleveraging. Best way I've found to trade is leaving it overnight. Okay, well, then why not just be long all the time? Right? Well, I mean, I suppose by not getting in... there's definitely a thing, too, that the market moves more overnight. These days, at least. I guess the thing that I don't think retail traders understand is that it is possible to make money in spite of a technical analysis signal being complete bunk. And what happens is people will go in and they'll do certain things and they make money from doing it, and they think it's because of their technical analysis when it's actually due to their holding period, the fact that they're going along in its equities, and or the amount of risk that they're taking on. Those are the three things that bias the results the most. So, and that is why when you look at the backtesting tools, they include ways of discounting all of those things. That's why we have stuff like Sharpe ratios and holding times and MFE, MAE, and so on and so forth, so that you can quantify how much that you're taking from that and discount it from how much edge is there in the actual technical setup. Because, you know, if it's a long holding time, I could just take random trades. I could just randomly pick stocks to go long overnight and, you know, probably make money. But in order for me to make more money than just holding the S&P 500 on average, I have to have some sort of an edge. I sleep only 5 hours. Oh, geez, dude. I'd rather sleep flat. There you go. I'm okay. You know, like here in the treasuries. So I one of the things that I would say is that I think that the what is the word? The calculations are different if you're trading treasuries, right? Because number one, treasuries don't always go up. Number two, you don't really have the same kind of vehicles to trade the treasuries as you do equities. So in equities, you got index funds. Now there are bond funds, but the returns that you get from bond funds are very, very, very mild, to put it. So in treasuries, you kind of have a different calculation. I can come in and take a swing and be long overnight. I still want to try and perform better than the treasury or the S&P 500, but well, I guess you're probably not going to trade better than the S&P 500 anyways, are you? Why don't you just go long and forget? Buffett would agree. Yeah, except for that the value trades haven't been working very well lately either. What's the actual average time that the 50% of the order gets executed? I don't know for sure, but I'm going to bet you that in most cases they're dividing it into 45-minute periods. Like if you saw a large meta order, probably the next section of it, you might see it in 45 minutes later. No, President Biden tweeting about the unemployment claims being good. Do you think that Biden is trying to call people's attention away from something else, maybe? I wonder why do you think he would do that? Why would you think he would focus? What is it that's going on right now that he's trying to distract us from? It's a tough one. Maybe I'm just crazy. Maybe he's just really thrilled about the low unemployment claims this week. Dude, if I was only getting 5 hours of sleep every night, that would suck, dude. You don't have any kind of sleep apnea or anything, do you? You know what happened to me the last night was I slept pretty well, I think, but I don't think I drank enough water because when I woke up, I was like, how hard I wake up is usually has to do with how hydrated I am. I love that you're just so aware a politician's trying to scam us that you just assume Biden is trying to hide something from us. I'm not sure if you got the joke. because it's so obvious that the Afghanistan thing is killing him, that he's desperate to get people to pay attention to anything else. Let's talk about masks in schools. Let's talk about the unemployment claims. Anything but Afghanistan. It's kind of weird because I don't think I've ever seen an instance of a politician trying to change our focus so hard. What causes a meta order to come back to its entry point before it reaches its target? If it comes back all the way, that could just be the result of a liquidity vacuum behind them, right? So when you're moving up here and now there's not very many orders behind you, it kind of creates a vacuum that can suck you back in, right? But then the other side of it is that there could be opposing meta orders the other way. And you got to remember that because of that liquidity vacuum that's been created, if you got a meta order that goes the other way, it's going to push price further. Here again, this one property of markets, I think this is the one thing that, like, if retail traders knew, it would change their perspective on markets. Like, think about it. Everybody always says, okay, here we've got the S&P 500 A, B, C, D, E pattern, right? So if I get this, then my expectation is higher high, higher lows. I should expect it to form a new high because this means that insiders are buying and the stock is going to move up, right? Conversely, if it goes like this, moves like this, and then a higher high, but then a lower low, then that might mean, oh, okay, something has changed and the trend may have changed. And so I need to be aware that it's going to come up here and go like this, right? But what we actually find is that you could have a meta order that is completely random and has no informational content. Okay, this move right here, this first move, or let's call it one, move one might have been because of news from the Federal Reserve. Move two might have been just random rebalancing from a hedge fund, right? And so this set of orders with absolutely zero informational content in it at all completely wipes out the price movement from the one that did have informational content in it. Yeah. Why? Because of properties of the order book. And should my expectation be that we move lower? No, actually, I think that my expectation should be that eventually people's anticipations of the future and people's anticipations of future order flow, or whatever kind of model that I might have, is likely to eventually move us in the correct direction so that we recover the fundamentals in the efficient market. But here again, if you're only looking at price and you're doing your analysis on price, there's no way from that information in price that you can make that determination. But if you're watching the news, if you're watching the orders, if you have models about what the orders are going to do, you can. That's my opinion. That's my perspective. I'm teaching too much. I should just stay quiet about this shit. I'm sure. Well, how many people are you? Okay, if there's 21 people here that know this, I think we're okay, because I think that there will still be about, for every person here in this stream, there's probably 10,000 other retail traders that at some point will won't understand that, and that you'll still be able to get money from. What are you saying? How do I spot a liquidity vacuum? Oh, yeah. I'm telling you too much. Okay, the way that you can anticipate a liquidity vacuum is a large amount of volume trading all at once. Is what tends to create the liquidity vacuum. It's not like everyone is now trying to run this new strategy. Yeah, and I think the reality is that the things that I'm sharing with you are things that I think that we have some significant empirical evidence to back, but it doesn't necessarily tell you how you should trade, does it? You still would kind of have to come up with your own trades based off this information. 19 of us will ruin trades with our one lots. Well, you know what? So first of all, I was putting orders out on here. Like I come in and I would put an order in here. Oh, how come that didn't change? Oh, it's because I come out and put an order out here. Okay. And I was taking a trade and I immediately saw some other people try and put trades on. I immediately saw a 50 lot show up and a 1 and a 2. I'm pretty sure that some of you guys are actually trying to mirror or fade the trades. So let's start with that one. And in this micro yields one, I probably could have an impact, at least on a 1 to 4 tick basis, right? But more to the point, the thing is that the inefficiencies that I'm looking for, these are inefficiencies that should exist regardless of how many people trade them, because they're created by the structure of the market itself, right? But what it could do is it could make me not competitive with it, right? You 20 coming in and putting your one lots in there could be the difference between whether I get filled or not. Yes. But please, why? What causes that? Why is a vacuum determined by the size of the volume? No. So NASDAQ trader, what causes the vacuum is that everybody that wanted to trade at that price has already done so. So if you get a situation where a large amount of transactions happens very quickly in one place, that situation is more likely to occur. It basically means like there's two big guys out there and they want to trade. They did it at that spot. Now there's nobody else that really wants to trade at that spot. And so it becomes an area of low liquidity. So what you will see typically is you'll see a large set of orders. And then after that, the latent liquidity is always low. So the reason why I saw it in this S&P 500, well, back when we come back to the 78, like you can see it right here, right? You can see that they created this distribution. But the reason that I knew it was happening was because I saw the big orders. You can't see them anymore, but I saw some big trades. And then after we moved away from those big trades, there was like hardly any size on the DOM. And then what do you see? Oh, they keep coming back to it. They keep coming back because they can't get out. They basically, to get up here, maybe if you were only trading, okay, so 200 to 500 orders to get through here, to get through a price, to get up to here. But then once you got in here, in order for them to dig themselves out of the hole, they had to get like 1,000 all at once. Yeah, logical. Well, there's a math behind it. I suppose part of the reason why I'm willing to say that is partly because there isn't that many people on stream, but also partly because you can read about this stuff. There's models and math behind why this happens. And in so much that a lot of educators besides myself teach this stuff, is just that like they probably heard it from another institutional trader and don't necessarily understand the math themselves behind why it happens, and so they're not able to explain really accurately why it happens. But I've certainly been in a webinar before where people talk about why do you get these distributions in the volume profile and explaining that. E-mini is down 12 points. Oh, they should come back hard, huh? I mean, I said that when they first touched 82 or whatever. It does kind of seem like maybe they aren't out of the woods today, though, huh? And I sure am glad that I sat on my hands and didn't take those trades back when we were up at 25. Or even all of this, because I think when I first was thinking maybe I want to take a trade, which was around 7. Yeah, we were a little bit lower. So maybe I might have been able to get like 23.3. But yeah, then it would have come back. So I'm glad that I didn't take that trade. I think I executed the way that I should. And I am being a little bit overly cautious because it's the summer and because there's not a lot of liquidity out in the instrument yet. Caleb says I can't even see the numbers. Right. Well, that's why when I put the trade on the other day, I mean, maybe it was just a coincidence, but I was like, other people are putting trades on just as I did. Could affect our film. Like here's the thing, going back to what the RJ Will was saying. If there's like 21 of us, okay, 21 lots in ES, it's you're gonna have a measurable impact, but probably not one that's really gonna matter, especially not in current market action where we've had a lot of price movement. Okay. But the problem is that I don't think that all you are trading 1 lots. That's one of the problems. I think that one of you are going to trade a 20 lot. And, when they're all combined, that it may actually be, 50 to 100 lots. And now all of a sudden, if we're trying to get 4 points to 8 points, then all of a sudden, yeah, it can matter, especially if it was like early in the morning. Especially if it's early in the morning. Five lots from Ace and 16 other sim lots. No. Maybe. So if we are pre-nicey open, let me show you. Since I'm sharing everything today. So here's an indicator. I should probably add this to my indicator. So there's two things that I should probably add to my indicator suite, right? But this is Alice. I should probably call it something. I should just call it SPS Alice. But okay. So our target is going to be 2 points. Okay. This is an estimate of how many contracts that market could support on a trade for 2 points. And it is based on the Kyle model, so it does not factor in square root impact. Okay. So it's a very, very rough. And you got to remember that Alice is like a maximum. Okay, so like if you took more trades than this, you would be losing money essentially, because you're at that point you're like the majority of the market action during that time. So really what you would want to do is a multiple of Alice, and I've been saying, just as a rule of thumb, a quarter of Alice. So before the market, if all of us were to take a trade that it was going to move 2 points over what period? I think that I'm doing like 10-minute period. But the period is just how we measure the market volatility is the only thing that the period applies to on here. Okay. But how far of a distance you're looking to get is a really big factor. So it's only 2 points in the ES. Okay. But essentially what this is saying is if our aggregate number of orders was more than 50, then it could become a problem. If it was over 200, then it's definitely a problem. Like for sure we're going to lose money. But during that market time period, 50 lots is enough to become a target. 50 lots is enough to become a target. So again, I've said this a trillion times, but guys, the impact that individual orders have on the market is far more than you would estimate. Like if I was going to come in and I was to say, how many orders would it take to move price X amount? And you're not looking at the order book to determine that. You know, like if I took a retail trader that doesn't know the order book, never looked at the order book, and I say, how many contracts would it take to move this? Right. And they go and they do the estimate. It was far, 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 far less than what they're going to say. Understand, orders move price about 5 times more than what our intuitive guess of what it should be. 5 times. 3 to 8, but on average 5 times more. Right? So to move it by how much, right? Yeah. But in this case, to move it 2 points. To move it 2 points. So what we're saying is if we know that the way that it looks at it, this is we know, it's assuming we know that price is going to move up 2 points. Like we know that. So if you know 100% certain that price is going to move up 2 points, how many contracts should you trade it with right now? Based on the current market conditions, right? Because if you take too many contracts, then you're having too much impact and you're actually losing money. So every contract that you take after that isn't helping you. It's actually and more extreme that it gets, the more it hurts you. Okay. So there's like this optimal size if you knew 100%. So what it's saying is if you knew 100%, the optimal size is 200. 200 before market. Now, once the market gets going, it's way higher. It's like in the thousands, right? Okay. But before the market goes, 200. And you just have to realize that it may not be realistic for you to trade 200 all at once. In fact, it probably isn't. Because it's kind of saying like the amount of volume that's trading at that time that, you know, it's kind of hard to get to 200. Okay. So you would probably have to split that 200 up. So that's why it should really be a percentage of Q, and that's why I'm just guessing. I don't know what this is something where what we could do is we could, if we were a big firm, is we would trade this sort of a thing and we would say, okay, when we move it up X much, what percentage of Alice becomes a problem. But I'm just guessing that it's 25% of Alice. So from my perspective, 25% of Alice, it's a problem. So if there's 20 of us in here, could 20 of us produce, if each one of us traded 2 contracts, 50 lots? Could we get 50 lots? Yeah, we could. Careful, you're relying too much on market generated data. Well, but that's what I was saying earlier. I don't know if it's that it's market generated that's really so much problematic, right? Like the thing is market generated data is ineffective at predicting future price. But that doesn't mean that market generated data is not effective at, for instance, predicting what your market impact would be, right? From the evidence that we have, apparently these large firms are able to predict their impact on an asset quite effectively, in fact. If those were winning contracts at the best price, you'll never get filled. Probably. That's why I say it probably needs to be a percentage of Alice. It's unrealistic for Alice to get completely filled, basically. But if you can predict market impact, you can estimate market future price. You can only do that if you know that the orders are coming, right? Because in order to predict market impact, what do I need to know? I need to know how much the price is moving, how much the volume changes, and how much volume there is, and then the size of my meta order. Right? I don't know. There's a couple of different things that you can because the models just get more and more complicated. I can look at the current liquidity conditions and the average volume that I would expect during the future time period based on historical averages and the size of the meta order. Okay? So, if you know the size of the meta order, then yes, you can estimate future price. Yes. So, what does that mean? You should only trade when you have a pretty good idea that a meta order is coming. Right? That's why what I kind of do is I sit here and I say, well, okay, today we are down really big overnight and there's all this option stuff and they tend to buy the dip. But if they don't buy the dip, then you're probably going to have a lot of volatility unwinding. So if they don't buy the dip, if they go on the open and it's not like a straight buy the dip, then, and I see some selling, then I should expect a huge sell meta order to come in from the deleveraging. But if I do see the buying coming in, then I should expect to see like a pretty good buy the dip. And this is how much the buy the dip should be. The buy the dip should be at least to 43.90. At least that should be their price expectation. So like how many orders would it take for them to get to 43.90, right? So now I can take a trade. Now I can say, okay, if I start to see order flows that match what I'm anticipating, and we started to see buying in the S&P 500 that was before the open. Now I can take a trade, right? So order flows confirming what I anticipated. And you can use the order flow to try and, pick the most efficient spot to get in. You can trade when you presume meta orders aren't coming as well. Well, you might be able to predict that the market is going to trade in a range. Yes. But I think it's really hard to make money off of that one. At least it's been for me. By the way, did you see Gary Norton and Peter parted ways? Well, yeah. So I don't really know what happened with that, but I don't think that it was anything sinister. Sinister is probably like an over dramatization of what it is, but like when you see that, I think your first thought is like, oh man, did they have a falling out? Like what happened? My understanding is that that's not the case at all. Because Gary Norton has his own fund and he wants to provide this education as well, it makes a lot more sense for Gary to provide the education himself. And from what he has shown me, I would say that I think that on his own and the system that he's going to be using for his education course, he'll be able to provide a better course than he could have through Jigsaw. So it made sense for Gary to go and do something on his own. And I think that both sides of that understand it. And so that's why probably you didn't hear them say anything about it when he first asked them to remove the course materials, right? And then people on Futures.io started to catch up on it and posted something. And so Peter, I'm guessing that Peter saw that, and so he decided, oh, I probably should send an email out about it. I think that's what happened. So that makes sense. Lucas says, rumor is there's a lawsuit. No, really? I don't think so. I don't believe it. I don't believe it. But that's the thing. When I talk, I don't want to reveal too much about what I talked about with Gary, but I asked him that. I asked him that, and he explained to me why it made more sense for him to go on his own. And I, just from his comments and from what Peter has said about it publicly, it appears to me that they both understood why that needed to happen, and that, I'm sure that Peter is probably disappointed in it, but that he understands. Right? So I wouldn't assume any drama there. Maybe I'm wrong, though. Maybe there's going to be a lawsuit, but I don't think. No, Gary Norden. I got some work to do in the next week, my friends. Maybe I should. I was thinking I could have recorded last night because it didn't work out, but definitely need to work out tonight. But then hopefully on Friday, I have to ask my wife what she's doing on Friday night, but hopefully I can record that on Friday night and then do all the editing this weekend. And then that will give me time to pare down my interview with Gary, because I talked to Gary for 4 hours. And, oh yeah, you didn't see about the FIO comments. Yeah, well, because here, I'll show you. Oh, we got to get going, man. So somebody asked about it, so I made a post saying, oh, I interviewed him and knew you'll get more information later. And then he came in and he said, the Matthew, who's a guy that's come by our stream a few times, I don't know if he's here right now, but he was saying, well, I had it, but it disappeared, and I was a little bit miffed about that. I didn't know you had contact with Gary. No, I messaged him on Twitter. So here's the thing. So he has a book, The End to the Bowl, which I think is a really great book. I don't think that Gary has, he's done a lot of study about technical analysis in the studies that are out there. But I don't think that he's quite as into the, let's disprove the efficient market hypothesis and come up with an alternate explanation and understand how orders move markets per se, as much as I am. But he all of the conclusions that he comes to match up with the theory that we know, which just shows that, okay, you know what? He was a professional trader and he knew how to trade, even if the way that he figured out how to trade, he didn't 100% understand all the theory behind it, which, and honestly, Gary knows so much more about trading and markets than myself. This is a guy that's been doing this for like 40 years, and I'm just some random guy on the internet. So yeah, I really liked his book. And so ever since then, he's been like the only person out there that really ticks all of my boxes on, like, when I look at what I learned when I was at the firm and what I've learned since, and it all matches. So I've been a huge fan of his. And so when it came out, and people have always asked me about his course. So when his course came out, or when he announced he was making a course, I said, well, I know people are going to ask me about it, so let's just see if Gary will tell me. And then he was the one that said, well, we could do an interview. I was like, oh, that would be so cool if we did an interview. So we did an interview and we talked for 4 hours. I have to say though, guys, I try to be really available. I wish that Facebook or that YouTube and Patreon had like better tools. You can message me on Discord, but I don't know. Maybe I need to make an OnlyFans, because I'm told that OnlyFans has stuff that makes it really good for content creators, for you to get better access to the content creator. As I would like to get more, and it's not even like, collaborating and building stuff, but like just being friends, like, because most traders just don't have other trader friends to talk, to shoot the bull with, other than here on the stream, right? But anyways, all of these guys are super available. You should do an interview with John. Okay, I'll ask him. I'm going to email him today. And I'll tell him, well, I did this interview with Gary and I've never interviewed you, so I think it would be really fun to do it. But actually, you know what? Let's wait until we have the Gary interview up. But it will be up like next week, because I think his course goes live at the 1st of September. Okay, I got to get going. Thank you, Win, for pointing that out to me. Okay, Seth, you nailed it. Release dates at my table, please. Anyways, it was fun. I really enjoyed talking to him. But I don't want to reveal everything that he told me, but I'm just gonna say that I don't think that there's any ill will or any drama out there beyond just that it made more sense for Gary to go on his own. Okay. Stay profitable, friends.